They massacred the longs. Why silver crashed 9.0s were. In 1 hour. Look at this chart. That vertical line shooting up from the candle. That is not a price move. That is a crime scene. Silver flashed to $83.71. Then in 60 minutes it collapsed to $74.47. $9 evaporated. Thousands of traders wiped out. Their accounts liquidated. But here is what they are not telling you. The physical silver did not crash. Only the paper did. Someone knew exactly when to strike. And when the trap was full, they pulled the trigger. This was not a market correction. This was an execution. And if you do not understand what happened in that 1 hour, you will be the next target. Welcome to Financial Announcement, the channel where we dissect the mechanisms behind market events that shape your financial future. Now, if you have been in the markets long enough to remember when gold was $300 an ounce, or if you have survived enough cycles to know that headlines lie, but charts do not, then you understand the value of institutional level analysis. Do us a favor and hit that subscribe button. Not because we ask, but because in the next crisis, you will want this analysis in your feed before the mainstream catches up. And tell us in the comments, where are you watching this from? New York, London, Mumbai, Karachi? Because what happened to silver on Monday is coming for every asset class you hold. Let's begin. On Monday morning, December 23rd, 2024, silver traders around the world opened their screens and saw something that defied logic. The price of silver had spiked to $83.71 per ounce. It was not a gradual climb. It was not a steady rally. It was a vertical explosion that happened in minutes during the Sunday night gap opening when Asian markets came online. Traders who went to bed on Friday with silver at $71.91 woke up to find it had jumped more than 11 in a single session. The chat rooms exploded with excitement. Social media filled with screenshots. Retail traders who had been waiting for this moment rushed to their computers, opened their brokerage accounts, and started buying at $80, $81, $82. They believed the breakout had finally arrived. They believed silver was heading to $100, maybe even $150. They used leverage, sometimes 10 times their capital because they wanted to maximize their gains. But within 60 minutes, everything changed. The price began to fall, first slowly, then rapidly. It dropped through $80, then $79, then $78. Traders watched in confusion as their profits disappeared. Some held on, believing it was just a small pullback. Then the collapse accelerated. Silver crashed through $77, then $76, then $75. At this level, something catastrophic happened. Thousands of automatic sell orders triggered simultaneously. These were stop-loss orders, safety mechanisms that retail traders had placed to protect themselves from major losses. When the price hit $75, it triggered a cascade. Each stop-loss order that executed pushed the price lower, which triggered more stop-loss orders, which pushed the price even lower. It became a waterfall of forced selling. Within minutes, silver had collapsed to $74.47, a $9 swing in a single trading session. For traders using leverage, this was not just a loss. It was total liquidation. Their accounts were automatically closed by their brokers. Years of savings wiped out in 1 hour. They had no choice, no ability to hold on, no chance to recover. The question everyone asked was simple: how did this happen? The answer lies in understanding who was on the other side of these trades. When retail traders were buying at $83, someone was selling to them. When the price crashed and retail traders were forced to sell at $74, someone was buying from them. That someone was the institutional players, the banks, the algorithmic trading firms that control the majority of futures market volume. These institutions did not panic. They did not make emotional decisions. They executed a strategy that they have used dozens of times before in precious metals markets. It is called a stop hunt. Here is how it works. The institutions have access to data that retail traders do not. They can see where large concentrations of stop-loss orders are placed. They know that most traders who buy at $80 will place their stop-loss orders around $75 because that represents a manageable loss. So the institutions engineer a price drop. They sell massive blocks of futures contracts at the peak, which pushes the price down. As the price falls and approaches the stop-loss zone, they sell even more. When it finally hits $75 and triggers the retail stop-losses, the cascade begins. The institutions then wait at the bottom. When the price reaches $74 and all the forced selling is complete, they buy everything back at a discount. They sold at $83. They forced retail traders to sell at $74. Then they bought those same positions back at $74. The profit is enormous, and it is extracted directly from the accounts of leveraged retail traders. This was not a natural market correction. This was not investors losing confidence in silver. This was a carefully timed attack that exploited low liquidity during the holiday week when professional traders were away from their desks. The timing was not accidental. December 23rd falls during what market veterans call Ghost Week. the period between Christmas and New Year when trading volume drops dramatically. Order books become thin. There are fewer buyers and sellers active in the market. In these conditions, price can be moved with relatively small amounts of capital. A few large sell orders can create the appearance of a massive crash, which triggers panic and forced liquidations. And that is exactly what happened on Monday. The chart now shows a candle with a long upper wick, a technical pattern called a shooting star. That wick represents the 83.71 high that was briefly touched before being rejected violently. But here's the critical detail that most analysts are missing. Despite the crash from the highs, silver closed Monday at $78.36. That is still $6.45 higher than Friday's close. Claude is AI and can make mistakes. Please double-check responses. There is a database that most traders do not know exists. It is not public. It is not accessible through any retail trading platform. But it is real, and it is watching every position that gets opened in the futures market. This database tracks where stop-loss orders are clustered. It identifies how much leverage is being used across different price levels. It calculates exactly how much forced selling will occur if the price drops to specific thresholds. The institutions that run the silver futures market have access to this information. They study it the way a chess master studies the board before making a move. And on Sunday night, December 22nd, when silver gapped open above $80, they saw something extraordinary. They saw an enormous concentration of leverage long positions that had entered between $79 and $83. They saw that these traders had placed their stop-loss orders in a tight band around $75. They calculated that if the price could be pushed down to that level, a liquidation cascade would begin that could drive silver down another $4 to $5. So they designed the attack. The first step was patience. They allowed the price to run to $83.71. This served two purposes. First, it sucked in even more retail traders who saw the breakout and wanted to participate. Second, it created the maximum distance for the collapse, which would generate the maximum panic. Then, at the peak, they began selling. Not small orders, not gradual exits. Massive block sales of silver futures contracts dumped into the market within minutes. The selling was so aggressive that it overwhelmed the buy side of the order book. The price started falling from $83 to $81, then $81 to $79. Each drop created nervousness among the retail traders who had just bought at the highs. Some sold voluntarily, taking small losses, but most held on, trusting their stop-loss orders to protect them. By the time the price reached $77, the institutions increased their selling pressure. They knew what was coming. They knew that just $2 lower, the massacre would begin. At $75, the first wave of stop-losses triggered. These were automatic sell orders. The traders who placed them were not even at their computers. Many were asleep in different time zones. Others were with their families during the holiday week. Their accounts sold without their knowledge or consent, executed by algorithmic systems that follow programmed rules. Each stop-loss that triggered added selling pressure to the market. This pushed the price to $74.50, which triggered another wave of stop-losses. Then $74, which triggered even more. Within 12 minutes, thousands of retail positions were liquidated. The institutions watched this happen in real time. They had programmed their algorithms to wait for this exact moment. When the forced selling reached its peak and the price hit $74.47, their buy orders activated. They purchased back every contract they had sold at $83, but now at $74. The round trip was complete. $9 per ounce, multiplied by thousands of contracts, extracted in less than 1 hour. This strategy has a name in professional trading circles. It is called rinsing the leverage. The term is cold, clinical, and accurate. The institutions rinse out the leveraged traders, shake them from their positions, and absorb their capital. What makes this particularly effective is the timing. Ghost Week, the period between Christmas and New Year, is when global trading volume collapses. Investment banks send their traders on vacation. Hedge funds reduce their staff to skeleton crews. Retail participation drops as people focus on holidays. This creates what market technicians call air pockets, price levels where there are almost no buy or sell orders. In normal market conditions, a $9 drop in silver would require massive selling pressure sustained over days or weeks. But during Ghost Week, it can happen in an hour because there is no one standing in the way. Historical data confirms this pattern. Similar attacks occurred during Thanksgiving Week 2023, Christmas Week 2022, and the holiday period in 2020. Each time, the setup was identical, a price spike during low volume, followed by an engineered collapse that triggered stop losses, followed by institutional buyback at the lows. The regulatory framework does nothing to prevent this. The Commodity Futures Trading Commission, which oversees precious metals markets, has rules against manipulation. But those rules are almost impossible to enforce during off-hours trading when markets are technically open. But participation is minimal. There is no law against selling large positions. There is no law against buying them back cheaper. And there is no law against timing these actions during periods of low liquidity. The institutions operate within the legal boundaries while exploiting structural weaknesses that retail traders do not understand until it is too late. But here is what the institutions cannot control: the physical market. While silver futures were collapsing by $9 in a single hour, something strange was happening in the physical market. Nothing. Coin dealers in London opened their shops on Monday morning and saw the same inventory they had on Friday. Bullion vaults in Singapore reported no unusual withdrawal requests. Mints in North America continued operating at normal capacity with the same order backlogs they had been managing for weeks. The premium on physical silver, the amount buyers pay above the spot price to own actual metal, did not change. 1 ounce American silver eagles that were selling for $6 over spot on Friday were still selling for $6 over spot on Monday. Canadian maples, Austrian philharmonics, and generic rounds maintained their spreads. Not a single dealer dropped their prices in response to the futures market crash. This reveals something critical about what actually happened on Monday. The price that collapsed was not the price of silver. It was the price of a futures contract, a paper derivative that represents a promise to deliver silver at a future date. Most of these contracts never result in physical delivery. They are traded, closed, and settled in cash. The futures market is where price discovery happens. It is the mechanism that determines the number displayed on financial screens around the world. But it is not the same as the physical market where real metal changes hands. On Monday, the futures market said silver was worth $74.47. But the physical market said something different. It said that silver was still scarce, still in demand, and still worth considerably more than the futures price suggested. This divergence is not new. It has been widening for months. As paper silver becomes more volatile, physical silver becomes more stable. The gap between them is one of the most important signals in precious metals markets right now, and most analysts are completely ignoring it. To understand why this matters, one must look at what happened to gold during the same period. Gold barely moved. While silver was experiencing a $9 massacre, gold traded in a tight range around $4,000 per ounce. It dropped by approximately $4, less than 1/10%. For an asset that typically moves in correlation with silver, this stability was remarkable. Gold's behavior reveals the true nature of what occurred on Monday. If the silver collapse had been driven by genuine concern about precious metals fundamentals, gold would have crashed too. If investors were losing faith in monetary metals, both would have suffered. But that is not what happened. Gold, which is primarily held by central banks, sovereign wealth funds, and institutional investors, silver, which has much higher retail participation and much more leverage in the futures market, got destroyed. But only in the paper market, only where leverage exists, only where stop losses can be triggered. The mathematical relationship between gold and silver reveals another layer of this story. Silver is what traders call the high beta sibling of gold. When gold moves up 1%, silver typically moves up 2 or 3%. When gold drops 1%, silver drops 2 or 3%. This amplification effect exists because silver is a smaller market with less liquidity. It overshoots in both directions. The same characteristic that makes silver more profitable on the way up makes it more dangerous on the way down. But here's what matters. As long as gold holds above $4,500, the floor under silver remains intact. Gold is the anchor. It represents the thesis that fiat currency systems are failing. As long as that thesis holds, silver cannot collapse permanently, no matter how violently it swings in the short term. The chart pattern that formed on Monday supports this interpretation. Technical analysts call it a shooting star or a high wave candle. It has a small body and an extremely long upper wick. That wick, stretching from $78 to $83.71, represents rejection. The market tried to push silver to $83, but sellers drove it back down. In traditional technical analysis, this is considered a bearish signal. It suggests that buyers are exhausted and that a correction is coming. But that interpretation misses the context. Yes, the upper wick shows rejection at $83, but the body of the candle, the range between open and close, shows something different. Silver opened the week at $71.91. It closed at $78.36. Despite the intraday massacre, the weekly gain remains substantial. The candle is not bearish. It is cleansing. It removed the weak hands, the leveraged speculators, the traders who were not prepared for volatility. What remains are the holders who understand that silver's path to higher prices will not be a straight line. This is the difference between a trend reversal and a shakeout. A reversal would have taken out the previous week's low. It would have broken through support levels and created lower lows on the daily chart. That did not happen. What happened instead was a violent spike in rejection that left the overall structure intact. The trend remains up. The breakout above $70 remains valid. The only thing that changed is that the easy money phase ended. Now begins the volatile grind. the phase where silver chops between support and resistance while building energy for the next leg higher. There is a question that separates experienced investors from amateurs. The question is not, what is the price? The question is, what is my position structure? On Monday, two different groups of people held silver. Both watched the same chart. Both saw the same $9 collapse. But their experiences were completely different. The first group panicked. They watched their accounts drop into negative territory. They received margin calls from their brokers. They were forced to liquidate at the worst possible moment, locking in catastrophic losses. Some lost money they had saved for years. Others lost money they had borrowed. The second group did nothing. They looked at the screen, saw the volatility, and went back to their day. They experienced no stress, no margin calls, no forced decisions. Their silver remained in their possession, unchanged by the chaos in the futures market. The difference between these two groups was not knowledge. It was not market timing. It was not luck. It was leverage. The traders who got massacred on Monday were using borrowed money to control positions larger than their capital. They were using 5 times leverage, 10 times leverage, sometimes even 20 times leverage. They believed this would amplify their gains when silver went up. And they were correct. Leverage does amplify gains. But it also amplifies losses, and more importantly, it creates a mechanism for forced liquidation that removes all decision-making power from the trader. Here is the mathematics that destroyed thousands of accounts on Monday. A trader with $10,000 using 10 times leverage controls a position worth $100,000. If silver rises 5%, the account grows to $15,000, a 50% gain on the original capital. This is the attraction of leverage. This is why traders use it. But if silver drops 5%, the position loses $5,000, which is half of the original $10,000. The broker sees this and issues a margin call. If the trader cannot deposit more money immediately, the broker automatically closes the position to prevent further losses. This is what happened at $75. Thousands of leveraged traders hit their liquidation threshold simultaneously. They had no choice. Their brokers executed sell orders on their behalf, regardless of whether they believed silver would recover. The institutions that engineered the drop understood this perfectly. They knew exactly where these liquidation levels were clustered. They knew that pushing the price to $75 would trigger a cascade. And they knew that once the cascade started, it would create enough selling pressure to drive the price down several more dollars. The traders who survived Monday without losses were the ones who owned physical silver or held unleveraged positions in mining stocks and ETFs. They had no margin requirements. No broker could force them to sell. They maintained complete control over their decision-making. This is the structural advantage that no amount of market analysis can replace. An ounce of physical silver purchased at $30 is still an ounce when the price hits $80. It is still an ounce when the price drops to $74. The paper value fluctuates, but the asset remains constant. This principle sounds simple, almost trivial. But it is the reason why certain investors have survived every precious metal cycle since 1980, while the majority have been shaken out during volatile periods. The 1980 silver spike saw prices reach $50 before collapsing to $8. Traders using leverage were destroyed. Physical holders who understood the long-term thesis simply waited. Many of them are still holding those same ounces today, 44 years later. The 2011 rally took silver to $49 before a 3-year bear market drove it down to $14. Leveraged traders were liquidated during the decline. Physical holders accumulated more at lower prices. The pattern repeats because human psychology repeats. Every cycle attracts a new generation of traders who believe they can use leverage to get rich quickly. Every cycle produces the same result. Volatility shakes them out, and patient holders accumulate their positions. What Monday revealed is that silver has now entered a new phase of its market cycle. The phase from $30 to $70 was the easy money phase. Prices rose steadily with minimal pullbacks. Traders who bought and held were rewarded. Leverage worked in their favor. The trend was smooth enough that even amateurs made profits. That phase is over. Silver has now entered what market veterans call the volatile grind. This is the phase where price swings become extreme, where 10% moves happen in single sessions, where stop hunts and shakeouts become routine, where only traders with proper position sizing and risk management survive. Technical analysts expect silver to consolidate between $75 and $80 for the next several sessions. The market needs time to digest the $9 meal it consumed on Monday. Buying pressure must rebuild. New support levels must be established. There will be no immediate return to straight-line gains. The chart will chop. It will frustrate traders who want quick profits. It will create false breakouts and false breakdowns designed to trigger emotional decisions. But beneath this volatility, the fundamental thesis remains unchanged. Gold is holding above $4,500. Central banks continue buying. Currency debasement continues accelerating. The conditions that drove silver from $30 to $70 have not disappeared. They have intensified. This is why the Monday massacre, despite its brutality, does not represent a trend reversal. It represents a filter. The market is separating speculators from investors, gamblers from strategists, leverage users from asset holders, for business leaders managing corporate treasuries, for family offices allocating multi-generational wealth, for individuals building financial resilience. The lesson is clear. Position structure determines survival. Leverage determines whether volatility is an opportunity or a catastrophe. The next phase of this market will be more violent than what came before. But for those positioned correctly, volatility is not a threat. It is the price of admission to asymmetric returns.